Welcome back to the Dividend Diplomats YouTube channel, everybody. Today, on this episode, we are going to talk to you about the significant difference between earning $50,000 in wage income versus $50,000 in dividend income, and why you want to be earning dividend income today.
Smash that subscribe button. Give us a nice thumbs up for Bert and I as we go over who wins the battle royale between the $50,000 wage earner and the $50,000 dividend income earner. The winner is who has the most net earnings after taxes. Let me tell you, this will change completely how you save, how you earn, and how you invest. This is why we are dividend investors.
All right, folks. Now, there are millions of employees in the United States. On average, each employee earns about $50,000 of wages annually. You're earning that $50,000 working 40 hours a week, 50 hours a week, 60 hours a week, 70 hours. No, wait, even some people are even earning that over 80 hours per week. Man, that is not fun. And then on top of that, with all that wage income you are earning, you're paying taxes to the federal government, state government, local, you're paying your FICA taxes, that Social Security and Medicare taxes. Man, it's a lot of taxes you are paying.
Yeah, definitely. Wow. I mean, the question that I had asked, over 10 years ago, is there a better income to earn versus being an employee and earning wage income? Because I'm tired of seeing, oh yeah, this is what I get gross pay. And then all of a sudden you see your net pay. And it's, you always ask the question, where did it all go? So there had to be a better way from a taxation perspective to earn money from a different source of income. Bring on the dividends, baby.
That's right, Lanny. Dividends, as we are going to show you, are a significantly better form of income. However, first let's take a look at an employee's income and how taxation works at the end of the year. When you're getting ready to file your taxes and pay good old Uncle Sam. We're going to start by taking a look at the tax brackets for the year of 2020, so you can see these while we're going through our example. So we're going to start with Joe Wages, who's going to be the person we're going to use to show for his employee income. Joe Wages is single, he has no children, and he makes $50,000 of income from his job. The standard deduction is also $12,400 for the year, as he is single. Therefore, after taking out the standard deduction, his taxable income without considering any other variations from this is $37,600. That's going to put Mr. Wages here in the 12% tax bracket, which means his federal taxes are going to be just over $3,300. So we're going to consider next his state taxes, which for us are 3%. For this example, that's another $1,500 right there. You then bring in your local taxes, which for us would be $1,250 based on our 2.5%, which will change based on the area you live. So after all of that, you start racking up there. You have your FICA, that's 7.65%. All in all, Mr. Wages is paying nearly $10,000 in taxes. Yeah, that's how it's taken about 20% out of his income. It's not what we want to see.
Wow. So you're saying every dollar he earns, 20% is already taken away?
You got that right, Lanny.
Well, I'm about to crush those results, Bertie. Let's see how this other individual that we'll go over, and his name is Mo Dividends. Similarly, he's also single with no children, but instead of $50,000 in wage earnings, he earns $50,000 in dividend income. And some of these sources of income could be from our top 5 foundation dividend stocks. Check it out up top. So from a tax perspective, just to get into the granular detail, qualified dividends are actually taxed at the long-term capital gains tax rate. So what does that mean? Well, that's the rate based on the tax bracket that you are in. And the capital gains tax rate can actually be 0% if you're in the bottom 2 brackets. Now, if you're in the additional 4 brackets, you can pay a maximum of 15% on capital gains.
Recap this small piece. Your qualified dividends tax rate is based on the long-term net capital gains tax rate, which is purely dependent on your income tax bracket. So my man Mo Dividends makes $50,000 in dividend income. Similar to Joe Wages, he gets the basic standard deduction of $12,400, bringing his amount down to $37,600 as well. Now, as you can tell, that's the second lowest tax bracket. So you know what that means. $0 in federal taxes, baby. Now, depending on where you live, here in Ohio, I believe you still pay taxes on that form of income. So a roughly 3% or $1,500 in taxes you would pay at the state level. Now, from the local level, from where we live, I don't believe you pay taxes. So that's $0 there. Then from our friends FICA, Social Security and Medicare, that is $0 on that as well. So in summary, Mo Dividends only pays $1,500 in taxes on $50,000 in dividend income, or 3%.
Man, I'll tell you what, Lanny, I think I know which tax situation I want. Mo Dividends, baby. So, all right, everyone, let's take a recap here. Joe Wages earned $50,000 in wage income, paid nearly $10,000 in taxes, and had a 19.8 effective tax rate.
And my man, Mo Dividends, brings in $50,000 in dividend income, pays $1,500 in taxes, or only 3%. Now, I know this was a lot of material, a lot of educational, hopefully, material for you. Leave your questions and comments below, and we'll do our best to answer them. But we also highly recommend you contact your tax or financial advisor if you have deeper questions or something that may be more applicable to you, as we really are talking from a high level. All right, everybody, smash that subscribe button. Give us a thumbs up. This is Bert and Lanny from the Dividend Diplomats. Over and out.